Hello and welcome to the Moving Market Podcast. I'm J.R. Gondik. Let's recap a little last week. The Federal Reserve surprised the markets and cut interest rates 50 basis points. And you saw the markets react favorably toward this surprise rate cut. The S&P, the NASDAQ, and Dow Jones all rallied to new multi-month highs. And the question is, why did the Fed cut interest rates 0.5%? The markets are debating. Overall, the Fed did a great job of masking if they're worried about the weakness of the economy to support the labor market, and the market rallied accordingly. The question as we look ahead, is the underlying weakness the market was concerned about a few weeks ago still underlying, or does this Fed rate cut really move another cycle of growth ahead? So when you look to see what the markets are looking at this week, a lot of economic data this week. You get some housing data. Because the question is, with lower interest rates, you haven't necessarily seen the activity pick up as far as purchase activity and other factors. A lot of conversations continue to pick up, but we'll see how this translates in the week ahead. The week ahead, we have priced in the market now post-Fed as 7 more rate cuts over the next year. And with all the economic data coming in, the question will be, is it 7, is it 8, or is it fewer? And the market will be looking to each data point to assess, how many rate cuts the Fed will have ahead. You have global PMI this week, which again will be a look to see, both the service and manufacturing sector. Is that underlying weakness still a concern? Or, is the market looking past any short-term weakness to the Fed supported the economy for that growth cycle ahead? Housing prices will be out this week as well to see, again, one concern with the Fed cutting interest rates is if buying activity does pick up, that housing prices would have another surge as we saw a couple of years ago. The reality is at this point, there's a lot of inventory nationally, and until you start to see that inventory really purchased and picked up overall, then pricing action should be limited, ahead. You'll see consumer confidence this week. So again, generally, with the stock market doing well, consumer confidence should rise accordingly, but we'll see if there's any kind of separation between consumer confidence and stock prices overall. New home sales will be out this week, as well as pending home sales for last month, to again measure to see if the conversations are translating to more activity ahead. You'll have the third read on second quarter GDP, and we'll see again what the final scorecard looks for the second quarter. Again, shouldn't be a market moving data point, but again, looking to third quarter, we're measuring, according to Atlanta Fed, just under 3% GDP. So if the Fed is concerned about the weakness of the economy ahead, it hasn't translated thus far. And again, you'll have durable goods, regular jobless claims on Thursday. Personal income and spending will be a big one as far as the markets are concerned. Looking to see, the underlying health of the consumer for the sustainability ahead. So with that, these are the key data points looking into this week. And again, the big item to watch as well is the 10-year interest rate. 10-year interest rate is around 3.75 today. And the question a lot of people had last week is, despite the Fed cutting interest rates, why did mortgage rates not fall accordingly? And again, that's determined by supply and demand. A lot of that was priced in the market. So you really want to look to intermediate and long-term rates, especially the 10-year, to see if that goes lower as far as yield in the weeks ahead. That could stimulate mortgage rates and a lot more activity. So with that, I want to thank you for a little look ahead to the week, and we'll touch base next week. Take care.